Thank you very much, Carolina, Jorge, and Bernardo, for joining us in this panel. Assets managed by pension funds today accumulate approximately $200 billion. We are talking about almost 60% of Chilean GDP and the savings of more 11 million of affiliates. Therefore, as a country, we don't have a space for mistakes. Net return is one of the most relevant factors in the objective of achieving a higher pension, with evidence indicating an effect of more than 25%. This figure highlights the risk that excessive regulation or inflexible investment guidelines lead to inefficient portfolios. Chilean multi-funds coexist today with almost 90 in structural limits if we aggregate individual plus aggregate limits. However, these limits eventually end up presenting asymmetries in different market conditions. Some of these restraints and the need to aggregate limits have imposed costs in terms of efficiency to multi-funds and even end up sacrificing diversification. I would like to use this panel to discuss how can we move towards portfolio that incorporate international best practices, finding the right balance between regulation and risk management. Are there opportunities to simplify or rationalize the structural limits imposed on multi-funds to make them more effective in diverse market conditions? How can we ensure that pension funds are protected while also enable them to achieve better returns and diversification? Can we create a regulatory framework that allows pension funds to adapt more swiftly to emerging opportunities and risks? I leave you the floor, and let's start by listening to Carolina.
Thank you for the opportunity to be here. And like us, I will talk about the regimen of investment. In general, no? In the presentation of Osvaldo, we saw the evolution of the regulation, and we saw the investment regime is not new. It's new in relative term, no? It's not come from the beginning of the system, but in general, it have the same approach to the limits that in the 80s, no? It's not a big change. We have more flexibility. We have less limits in the law and in the regime. We have more in this investment regime, and that's good. But we think we need to change different things. But to explain what is the approach to this, we have three kind of limits. One is the structural limit. There are the approximation to market limits, where the equity factor is the main risk factor. How much equity each fund can have, how much foreign investment can have is the source of market risk. Fund with less equity, also they are ones who that may have less foreign investment, and this is less risk. That's at the end is why the Fund E, for example, have most of the investment locally, and we have some issues in the last year to this concentration. No, we think the percentage in equity is a rough approximity of the market risk, without taking in account the interrelationship between all the assets in the portfolio. Another structural limit is the limit in alternatives, which set the band for the maximum equal for all the fund, but in the previous logic, it also decreased for the fund with less equity or less risk. Then we have some group limits, active group limits. They are more specific and is some approach to limit the equity factor with in the new asset, like a convertible bond or promise in the case of alternative. But in general, it's the same approach. And then there are limits per issuer that have more to do with credit risk, or like Osvaldo say, is to evade a conflict of interest. That's the idea of it, no? A percentage of the ownership of a company in Chile or a series of bonds seems reasonable. It's good to maintain this kind of thing. But we have a lot of inconsistencies, like The FANI can have a bond from high yield companies. However, it can have equity for the same companies. One example is LATAM. We can in the FANI you can have equity of LATAM, but not the bond of LATAM, and is an inconsistent because you access to the most risky part of the capital structure and for the same emission. Another inconsistent is, for example, you can buy the ADR of some equity in Brazil, but not the same equity in Brazil. That's the risk of the asset are the same, but the only thing is you trade the asset in a different country with a different, I don't know, maybe the country risk more than the risk of the asset. The bigger inconsistent is consider all the equity equally. There are some different, you have some difference in terms of country, sector, and the sensitivity of different factors are the same for the law. You can have a technology asset, also equity. We have a big correlation with the rates, but you consider the same for the limits, not different. The other things is in terms of the fixed income. The risk classification is the big issue for this. It's not the sensitivity to the rate. The duration of the fixed income is not considered in a good form. And the limits of the derivative is not considered a real contribution to the risk. For example, in the case of currency hedging, the term of the derivative is not considered from the limit, and it's a big part of the issue, the risk you take when you make that. Okay, why to change? First, you have new conditions. The volatility and the correlation of the asset are changed and will change maybe. And this kind of approach consider the same kind of relation or the same kind of what is more risky or less risky. Now you have a more sophisticated portfolio. Okay, this is start with when we, like Osvaldo say, you give a very good example that you only have fixed income, then you increase to equity, but with a big part of the portfolio in fixed income, maybe this kind of limits was okay. But now you have a derivative, foreign investment, alternative, and nothing of the regimen of investment give a big picture or a good picture of the risk in terms of the portfolio. And that's why you need to have more direct control, not only to say all the equities are the same or the fixed income are the same. That's an idea. This is not new for us. We talk about these kind of things many years ago. We insist into need to change to simplify the limits and put some kind of risk limit. This is our approach. But
thank you very much, Carolina. Jorge?
Okay, thank you everyone for coming, and thanks Invest for the invitation. It's a pleasure to be here. I'm going to approach the topic in a very different way. I understand that discussing about investment guidances in pension funds is not really a very sexy topic, so I really appreciate the time that you're spending here. But it's even though it's not very sexy, it's very important, and it's very important because at the end of the day, it's the way we transform our savings into a good pension outcome, and the way we decide to do it, it will definitely have implications. So that's why I really stress the point that this is a very important topic. Earlier today, the superintendent was mentioning that the fact that between 50 to 70% of our pot at the end of the day comes from the returns of our investments is really relevant. So this is something that we should really spend time. Let me start by saying that what I'm going to show today, what I'm going to do today, is I'm going to refer to replacement rate as the measure of most of the graphs that I will show, the tables I will show. Replacement rate is the relationship between the income that you make before retirement and the actual payment that you receive. In Chile, what is considered a good replacement rate is around 70%. So that's sort of consensus. I'm going to use that metric as the benchmark to most of this, to most of the topics. And of course, I'm not going to go into details on anything else that the investment guidance itself. So I'm not going to talk about anything that might affect pensions except the investment policies. I know this is not, it's not supposed to be a big talk, so I'm just going to briefly outline a couple of things that I think are important. I'm not going to go in depth in most of them, but what I want to do is focus on things and specific topics that I think are important that a policy should have that are currently not in the investment guidance that we have, okay? I'm going to do this without relating them one to each other. Of course, in a bigger and more developed discussion, all of these topics should be related. Okay, so what I plan to do is briefly discuss 4 main issues. The first one is explicit return targets. Okay, the second one I want to talk. It's a little bit about risk measures. Why are they relevant to pension plans, and why one risk measure is better for a pension plan vis-a-vis other investment mandates. The third topic that I want to talk, and the superintendent briefly discussed this early in the morning, is the risk of not taking enough risk. That is something that is happening today in the Chilean system in a way. And the fourth, it's a very general effect on the restrictions on the portfolio construction and what is happening to portfolios. As I said, I will cover all of these topics very loosely, and not relating them to each other, but of course they will interact. Let me start with the explicit return target. So, when we say that our system should be able to deliver good pensions, and that by good we're thinking 70% replacement rate, we are implicitly saying that we have a return target. What I have in this chart is the month of contribution of someone that is putting money into the fund. It's more than 100% because I'm assuming that some people actually do have voluntary savings. So over here, it goes from 120% with someone that puts extra money to 100% to 86 and so forth. And then I'm using a real return on the other axis. And inside, we have replacement rates, okay? So this is a very, very simple example, and it's very bold simplification because I am using flat returns. Of course, returns over their life are not going to be flat, but this shows us that in order to deliver around 70% replacement rates for someone that puts money all of his life, we should aim for a 5.5% real return on average over the cycle. This doesn't plan to be an exact number, of course, but it should give us some sort of guidance of what our portfolios should deliver and how we should build a portfolio that is able to target this sort of returns. Okay, this is something that is currently not in any way touched in the regulation, and it's pretty obvious that there is an implicit, or actually almost explicit return target if we want to achieve 70% replacement. So this is something, in my view, important. The second topic I want to address briefly is measures of risk and relevance for pension plans versus other investment mandates. Think about this picture for a moment. It's December 31st of any given year, and you are a portfolio manager of a mutual fund. Okay, you've delivered this. The last year of return of the fund that you manage is down 3%. Over the last 3 years, your fund is only 1% up, but the market that you're benchmarked to is down 5% for 1 year and 1% down also for 3 years. Guess what? You are happy you think you did a good job. And probably your boss thinks you did a good job, right? Probably you're gonna get a bonus. But are your clients happy? The flip side of that coin is that, think about the same manager on a year that is, first year, 1 year's up 10%, let's say for 3 years up 20%, and his relevant market or competitors are up 13% and 25%. He thinks he did a bad job. But how are his clients at that point in time? So what I'm trying to say with this is that depending on the way you look at your performance and the performance metrics, define the way you behave. So performance metrics define incentives. Those incentives define what the investment team aims at, and at the end of the day, that translates into a portfolio construction. Okay. So what I did here on this pie is basically show different ways of approaching risk. Absolute risk typically use metrics of VAR, CVAR, stress test. It's an absolute mentality on risk. So they wanna make money given a sort of amount of risk in an absolute term, right? So that is typically used by banks, life insurance companies, and hedge funds, or people that aim to have absolute returns. Benchmark products, the example of the mutual fund manager I just gave, typically use tracking error as their approach to risk. So how much am I deviating from a benchmark or to my peers, right? This is absolutely true and absolutely the case for mutual funds or ETFs, and in some way to pension funds in Chile too. The way they benchmark themselves is against the average of their peers. When they publicly say about how they're doing, they do a ranking of themselves to others, right? And then there's a shortfall risk, or an absolute risk to a target. If you give me as good, my first point, that there is an explicit target of return, then our main risk is really shortfall to that target. We control that in many ways. Typically, it's stress test or CVAR or some sort of metrics like that. And this is normally what is used by endowments or pension plans in developed countries that do have, in most of them, an explicit target of return. So this is also something that I think is important to include in investment guidances. I'm going to cover the third topic briefly, which is the risk of not taking enough risk. The superintendent was very kind today to show us the amount of people that are moving from one fund to the other and the amount of people that are currently in Fund E. And it was very scary to see the number of young people that are in Fund E. What this table shows is basically the probability of not reaching your replacement rate of 70% if you put money in any given fund each month for 30 years, right? So if you put money all your life or 30 years in Fund A, you'll have a 16% chance of not delivering a 70% replacement rate, or 84% of achieving a replacement rate of 70%. But look at what happens with Fund E. Fund E almost guarantees you not to deliver a 70% replacement rate. It's 85%. So only 15% of the times in this 10,000 simulations, only 15% of the time, putting every month money in Fund E, you will be able to have a replacement rate of 70%. This is something very, very risky, and it is very bad for people to be in the incorrect risk framework over their life, because even though they can put money all the time, if they don't take enough risk, they will not achieve the replacement rate that they hope. Let me take you now to my last point. My last point is, it's about the cost of restrictions. So what I did here is something relatively simple. I took all the main benchmarks that the pension funds have, and then did mean variance simulation, and then add all of the restrictions that are active. And this is done with benchmarks, so it's a very basic example, right? And I don't want to say explicitly that this is the cost of the regulation. I'm just trying to loosely explain what the impact of the regulations look like. The point that I want to make here is that in general, the industry standard is to do regulations at portfolio level, right? And not at asset class level. So all of the limits that Carolina was mentioning, in general, that is not the best way to construct a portfolio, right? The other thing is important is it's important to use a broader opportunity set. So currencies, for example, derivatives, factor exposure, alternatives, all of them should be included as part of a guidance. And again, as a portfolio level. And if we want to implement any hedging or any overlay, currency hedging, managed volatility, tail risk hedging, you name it, whatever you want to do, again, you should do that at portfolio level and not at asset class level. This is not the way we do it in the existing framework. Normally we do individual assets. The case of the currency is pretty clear. So my suggestion would be to change that to a broader portfolio level. What we do with the currencies is definitely not standard. I don't think it works very well, and I think it has proven costly over years. So to finish, basically, I mean, we've had 40 years of a successful story of pension funds managing money in Chile. But I think we're at a point in time where we have good opportunities to improve our investment guidances and the way we build stronger and more modern frameworks for portfolios. To do so, as I said, I propose to basically use some concept of goal or target, use modern risk and portfolio construction tools. I know that doing this today is much easier than doing it 40 years ago when we didn't have machines or whatever. So today we do have technology that doesn't make this extremely difficult. I think it's important to focus on the correct amount of risk. Not having enough risk is very bad. And I think including a broader investment set and opportunity set is also important. And I think all of this are possible ways of improving the probability of delivering better replacement rates that at the end of the day is what all our savers expect. So with that, I'll take questions. Thank you very much.
Thank you, Jorge. Bernardo, the floor is yours.
Sorry.
Okay, can you hear me? Yeah. Okay, so first of all, thanks a lot for the invitation, Cristobal, for organizing that. To me, it's a great pleasure to be here. I am not Chilean and I do not work in the financial industry. So my emotional justifications are, I have 2 Chilean daughters. I think that counts, right? And I lived in Chile for 12 years. So I think that explains the reason why I'm here. And also I was funded by the Chilean government through a project to work on this topic. So I worked a lot and I interacted with some of the people here. So it's great. It's great to be here in London and participating on that. I'm a professor. I work in academia. So yeah, maybe the way I talk is going to reflect the fact that I'm a professor. So if I start giving a talk, a class, you can interrupt me, okay? So again, I think the idea here is to be brief. How do I pass? This one? Yeah?
There you go.
There.
Yeah, okay. I mean, speaking after you two, I don't know if I should comment what you say or say what I want to say. So I'm going to try to do a mix. I think it certainly affects what I had planned to talk about before. So I don't know. Maybe I'll try to be even more specific on the suggestion. So risk. Everybody talked about risk here. Yeah, risk is complicated, right? So it's nice to be invited to those events because you start thinking about how to explain this to people. So to me, if you ask me to define risk, it's hard. Okay, when I teach students, say, Professor, what is risk? I don't know, so I come up with this answer. I think in academia we do this a lot. We change the question to something that we know how to answer. So I say risk is like temperature. If you Google, and I recommend you doing later, try to find the definition of temperature. It's very complicated. You're going to find very long videos on YouTube explaining what temperature is. So risk, we have this intuitive thing that it's about dispersion, it's about volatility, it's about losing a lot of money, right? And as Mr. Macias, the superintendent, mentioned in the morning, it would be interesting to incorporate that to some extent in the rules. So I think Jorge mentioned the word proxy. To be even more specific, the way I like to convey this idea is to me, measuring risk through portfolio limits is a bit like measuring intelligence through IQ. It has something to do, but I don't know if that defines the intelligence of a person completely. Again, it has something to do, but it's not perfect. Another analogy, I think it's very fit for this event, I guess, GDP per capita. Does that mean the well-being of a, does that really describe the well-being of a country? Unclear, we can discuss, right? And that's kind of what the portfolio limits, they do. They are related, of course, the people who propose that are smart people, but I think they are a proxy, okay? So how to define those limits? I think, if I remember the numbers, I think Mr. Macias mentioned 50, and I think Cristóbal raised to 120, if I'm not mistaken, numbers that you have to define. I think you mentioned right now,
89.
Anyway, the numbers are big. I think it's very hard to come up with the best numbers, the good numbers for that. And it hurts, because if you put the wrong numbers, if it's too small, you find a good investment, you're going to be blocked by this limit. So you're losing maybe 1% a year, which everybody here mentioned that is very important. So I think it's a difficult task, and it's going to become harder as more and more classes are incorporated into the system. So again, I work in academia, I can make radical suggestions. Okay, so I'm going to use this privilege here. I would do away with all of those, and I would use 5 numbers. Ideally, to me, we would have like one number that defines the risk level of each multi-fund, like a constant for the A, B, C, D, and E, and that's it. Okay, and the asset classes, as they come, they're going to have some risk, and then you would see if they could be added to the portfolio or not. If they violate the risk of fund E, no. Then they have to move to the other funds. I think that's doable, okay? Just to give an example, people are mentioning risk measures. And also a very interesting comment from Mr. Macias again. He said something very nice. He said, there's not a clear risk measure that is good for pension funds. I agree with that. That's a correct statement. And I think it's very interesting to hear from a person in such a position. But then I think what I'm going to say is, I know the ones that do not work. So I ask for the decision makers in this room, do not use the VAR. Okay, I really don't want to see Chile using the VAR. Please don't do that. So for people that do not know what this is, I have like a very simple example. Again, I'm sorry, my professor's side is here. So you say, oh, I don't want to lose more than 100 million pesos. So then first year you lose 80, good. Second year you win 20, good. The other year you gain 70, good. And then you lose more than 100. You're going to be like, oh, how much did I lose? 101? No, maybe you lost 900. So the VAR has no control. When you lose more than what you said you wouldn't lose, it happens with a small probability, 1%. But when it comes, it may destroy your portfolio. That's the VAR, whether you like it or not. So the CVAR, and I repeat, the superintendent is correct in his assessment. It's not the silver bullet, but it controls these losses after you lose more than the 100 million that I said before. So I think there are alternatives. I work a lot in risk measures in different contexts. I work in a problem in mining, for example, and just, I don't know, to share something that I found. In mining, it's not the CVAR, it's the entropic. So if you want to talk about risk measures with me later, I really like this subject. So each area probably has a way of measuring risk. Again, I don't want to go beyond my time. Okay. Second thing that was mentioned by both of you is this default strategy, right? Which is the strategy that the Superintendencia does for people that do not actively manage their portfolios. I have this number here. I think it's from a paper by Bernstein and others. Maybe it's not updated, but I don't think it changed a lot. I don't know. Well, from your paper. Yeah, pleasure. Yeah. So again, I couldn't find a better, you have other numbers there as well, which also clearly say that people don't understand. look, financial education is great. I think it's fantastic. We should do. I think I don't know if Paulina is here. Paulina, she's doing a fantastic job in financial education. Her videos are 1 minute and 40 seconds. They are clear, direct, and very well explained. So I think this is great. I just want to say that doesn't mean we expect in 6 months, in 1 year, everybody in Chile, and this has nothing to do with Chile. No country, people come, oh, now I can actively minimize. That is absurd, okay? In my opinion, the role would be to make people understand more what's going on, okay? To stop saying things like, they're stealing my money. I think everybody's a bit tired of that, okay? I think with the retiros, the withdrawals, we saw that was not the case because I made a withdrawal and the money was there. So I think we should move on, okay? This is over. And in this sense, I think if we do that, people will understand more what's going on. And if they do, one simple suggestion, that's the goal of this slide here. Target funds, this target date fund logic is very old. Many companies in the US do that. I think the US influenced a lot. This industry of 401ks, they use a lot of those target funds. Look, the default option is not terrible, but look at this graph, like blue or light blue. I don't know how well you can see, or purple. I see blue here and purple there. This is what happens right now. And by the way, I don't know if you can see this vertical line, the G. This is the 70% that Jorge mentioned. So you want to be to the right of this vertical line. Okay, so ideally, you would like to invest in such a way that everybody achieves the replacement rate. So yes, I retired with 70% of my salary. That would be great for everybody. So in blue, you see what happens right now with the B, C, D life cycle logic. It's not bad, but you can do better things. It's myopic. It's what people call open loop in academia. It's like, I want to go from here to the other side of the room, no matter what. So if you put a barrier here, I want to deviate from this barrier. No. I said I want to go through this path, and if I fall, I don't mind. No. So I think you should at least look at the wealth of the person. See how much money this person has. So it doesn't make sense to migrate to C if the person made 3 withdrawals and lost a lot of money last year in the financial market. No way. This person should go to A, in my opinion, especially if the person is 40 years old, 42 years old, even 45 years old. Okay? So the BCD logic, I repeat, it makes sense. This was proposed by intelligent people, but I think it can be done better. So we did this experiment and we were able to obtain red. If you see red, it is really to the right of this vertical line of what I call G, okay? So, and I go back to something that Jorge said. An endowment, what's the goal of an endowment? Pay 50% of the salaries of a university. What's the goal of a family office? Some person comes and says, I want to double my money in 10 years. That's a goal, right? A valid goal. Here, I understand all considerations and I respect that there are preferences regarding where to invest. But in my opinion, the only goal is to reach this G, this 70%. All the other considerations are secondary. If you can make sure doing financial engineering, let me use this term in the very appropriate way. This is financial engineering. This is how engineers in finance produce a path that, boom, reaches that goal. And by doing that, you can reach this 70% if you use those techniques. So I think this would also be improved if we focus on the logic of target funds with this thing called the glide path, if you never heard this term, right? You want to do a path so that you arrive at the desired goal. That's it.
Thank you, Bernardo. Thank you very much. And let's have a deeper look to some of the points that you already discussed. Carolina, according to your point of view, what instruments or guidelines should a new investment regime include?
Okay, we think we need to incorporate some risk in terms of the portfolio like this, and some of the issue limits. There's more like to evitate the conflict of interest. But in general, our approach is to consider at level of portfolio. That's the most important thing. I have some issues with each measure. Maybe the C-bar is better, but I don't know really how to explain to the people this, but it's better. But and then we want a investment guideline with less limits, and that's very careful because, like Osvaldo said, some of the limits are in the law, some in the regime. But if you aggregate risk to the actual regime, most the law, I suppose, is maybe it's better to continue with we have now. Okay, always we can worse. This is really true. That to have an approach of the portfolio, I think some of the risk of the portfolio are not considering the limits, and that is inefficiently. We need to improve the performance of the fund, like Jorge and here say. We need to focus in what is the target of we need, and then to define the fund. But it's a mix of some limits, better than we have now, and some risk measure.
Jorge, what role should currency hedging and financial derivatives play in a structure like the one that you suggest?
Well, I mean, it's they are asset classes at the end of the day. So adding them to a portfolio makes sense. There was a very big discussions like 40 years ago if currencies were an asset class or not. But it's very clear at this point in time that they are an asset class. They deliver returns. And as a matter of fact, there are a bunch of written papers about carry and why carry strategies work over time and so forth. So I think now it's pretty clear that they are an asset class. They add value, and in general, all of these sort of alternative sources of return tend to be uncorrelated to most of the major markets. So I think factor exposure through derivatives or through cash instruments even make a lot of sense. Currencies make a lot of sense. In general, derivatives make a lot of sense. Of course, you have to measure the risk of them correctly using them as at an aggregate portfolio level, but they do help you build better portfolios. So I'm pretty confident that they should be part of any modern policy or guidance for pension funds.
Bernardo, based on your academic experience, are there examples of similar discussions in other financial areas?
Yeah, that's a nice question. So yeah, I mean, pension funds are quite unique in a way, but then I would think about the insurance industry, for example. The Basel agreements are very specific in terms of how to measure risk. Again, risk for them is something completely different. We discussed before. I don't think I need to go back to that. And from Basel II to Basel III, there was a big discussion on risk measures. So I don't know, I could even give the open suggestion here to the Association of FP or the superintendent or anyone that wants to do that. Do a study group on risk measures. I don't know. I know 10 maybe, expected excess, QDEV, ASD, CVaR, etc. Do them, show to the practitioners and say, does it make sense to you? Does it look like a portfolio? So yeah, I'll draw experience from these other areas and maybe see how well they perform in pension funds.
Thank you. Carolina, the reform suggests changing the current multi-fund scheme for target date funds. What should the investment regime be for these funds, and what's your opinion on them?
Okay. First, the approach of the investment regime we have here will be the same for target fund or for multi-fund. You need to have a better approach to the risk. You need to take enough risk. That's enough. My opinion about the target fund, target date fund, I don't know. It really is the better form to obtain better return. At the end, it's not so different than we have now. We have a path through the funds, and then each people have a change through his life in terms of the exposure. No, I really don't think you need to destroy all to have a new. You need to focus more in the improve the performance of the fund, the risk they take, and that's my opinion. No, I really think the change in the investment approach is to take more risk, to evaluate the portfolio at the level of portfolio more than change these things. That's my opinion. not the equal to the regulator, but that's it.
Jorge, and focusing on target date funds, are this scheme or these funds consistent with the type of limits or the structure that you propose? What's your opinion on that?
I mean, I think target date funds is like a second order problem, in my view. I think we have bigger problems in the investment policies today, and this is sort of like the icing of a cake, but it's not really the cake, right? I think, I mean, you could build target date funds that are consistent with good policies, and you could have horrible target date funds also if you don't have good policies for them. So what I really think is that this discussion, which is, I understand, is part of a broader discussion that has been taking place in terms of how the change on the system should look like. I think, in my view, this is really a completely secondary problem. And if we want to focus on the investment guidelines, specifically as part of the reform, I think taking some of the very basic and obvious things like having a target, putting some risk limits on it, measuring the risk at portfolio level, using the amount of math and computer power that we have available now to do it, I think there are easier ways and sort of first order problems. And I think target date funds could be like a second stage issue.
Thank you. Bernardo, Jorge mentioned the data and technology. What's this machine learning and data science play? What role does machine and data science plays in this type of limits?
Okay, that's again a question that can take anything between 2 minutes and 2 hours. So I'm going to target that 2 minutes. So look, I don't know. In energy, people talk about smart energy. I think maybe it's time for smart pensions, right? I mean, we have this data. So maybe the machine learning could analyze your data and send you warnings. Sometimes the investment increases a lot your chances of reaching the replacement rate. But if you have gaps, for example, you have to put more money, right? So, for example, you could receive an APV warning. I mean, you have to put more money. So maybe it's not from the AFP, maybe from a robot, maybe like a chat bot that uses all this computational power that you're saying and saying, hey, your flight, you're not going to land where you're supposed to land. You have to put more money. Or things are going fine. That's why you should change to fund D right now, maybe because you are above your glide path. So those things, I think it would be positive. As an anecdote, to conclude my reply, I worked at a prestigious Chilean university before. And my colleagues, they were not in finance, and they said, oh, I know you have been working in finance. Can I talk to you for a second? I repeat, my colleague, a PhD, very smart person. I like her a lot. She said, so I'm using this Felipe de Forado. Shall I change my... So it's very hard. Financial education is very hard. I mean, she was making basic mistakes because, you know, she was not leveraging data and she was getting advice that, as Mr. Macias mentioned, I think in 2020, 74, I think it was your number of people changed. That doesn't make any sense. I think with more data and with machine learning tools, the changes could be less and more meaningful.
And considering these measures and tools, do you think that it's possible to get a precise expectations of pensions for affiliates?
Precise, the answer is easy. No, you cannot, right? I think that's the difficulty in communicating. I think it's an effort that most of you here in the room have been doing. Yeah, if you have a DC system, as the Chilean system is, with 3 pillars and all that, sometimes people ask, and I'm pretty sure people that work in FP got this answer. So what's going to be my final pension? The person is 20 years away. You cannot. And you as a person who manages money, you also get questions like that. And it's the nature of the problem. You mentioned the 5.5% per year. That's a number that you use to run the calculations, but you know that year by year is going to change. So no, the problem will always be hard. So maybe that's why data science and machine learning, using all this data, could help talk to the person, communicate better, and make people understand that it's always a distribution in the end.
Thank you. Jorge, my last question. I mean, looking to the structure that you propose and the type of limits that you propose, do you think it's really complex to implement it? How, I mean, looking to the regulator, what kind of changes do you expect to go to a structure that the one that you propose?
Actually, the answer is it's easier than the current limit. I think the big problem here is to trying to agree on because this as Carolina was saying, this requires changes in the law and changes in the investment guidance policies. So aside from the fact that we have to get these things approved by Congress people, forget about that. The set of limits is much smaller, so it's relatively easier to implement, and it's relatively easier to control. We did a couple of years ago with Alejandro Besanilla that I see here, a study about the proposing a set of limits based on basically these parameters that I'm saying. And we did something extremely less sophisticated at what Bernardo was saying, and he probably will punch me in the face because we just used volatility as a proxy. And we just took a volatility target. This is very old, by the way. Volatility target funds have been existed in the US for 25, 35 years, right? So we just took a volatility target for fund A, B, C, and D, and E, and built limits based on volatility and concentration, focusing on drawdowns and stress. We came up with, 10 meaningful limits per fund. It's relatively easy to implement, easier, in my view, easier to control, especially now with good computers. But the problem of all of these discussions at the end of the day is, as I said at the beginning, this is not a very sexy topic. Nobody really gets super excited about this. And it's difficult to get approved and get people engaged in this. So to me, it's more a Mr. Macias problem. So he should get people more engaged on doing this and getting the political will to do it. But the set of limits is relatively simple.
Thank you. Well, as we conclude this panel, it's evident that we face a complex challenge that demands careful consideration, collaboration, and innovation. We have explored the significance of net returns and recognized that achieving higher pensions requires maximizing investment performance. It's crucial to seek a balance between prudent regulation and flexibility to navigate the ever-changing financial landscape. Let's continue this dialogue beyond this panel, looking to create a stronger and more resilient pension fund system for our country. Thank you very much. Thank you.